You're in the right place if you came to learn about how to profit with options tonight. So that's what this webinar is all about here. So how to profit with options, and I'm really just going to be breaking down how this whole thing works with options, at least as best as I can during the next 45 minutes. All right. So let's get into the information. So here's what's on the agenda for tonight. I want you to walk away from this learning why option traders have a unique advantage over other stock traders. I also want you to understand and discover why trading stocks is more risky than trading options. So you may have heard that, I heard trading options is risky. I'm going to share with you tonight why it's actually the reverse, why only knowing how to trade stocks is more risky than trading options. And that's what you're going to take away from this training tonight. You're also going to uncover the secrets to growing a small account with as little as 500 bucks using options. And maybe I shouldn't have put the word 500 bucks in there, because the example I'm going to show you it's with like $3,000, but you can basically take that example down to 500 and say, if I had $500, what could I do with the same example? Does that make sense? So, so that's what I'm going to share with you tonight. And if you got questions, hold them to the end, because I'm going to take some questions at the end. And I'm going to also give you an opportunity to partner with me and get some additional training if you choose to. So let's dive into it. And also, this is one of my favorite parts. We're gonna cover how you can control expensive stocks like Amazon, Google, Tesla for a fraction of the cost, because most people don't trade the best stocks out there because they don't think they can afford them. But I'm going to show you how with options you can afford some of the very best stocks out there on the market. All right. Now, who is this webinar not for? So this is not for you if you're already a sophisticated investor. This is not for you if you already know how to make money in any market condition, which means you know how to profit no matter whether the market's up, down, sideways, or upside down. You already know how to make money, then no problem. Go ahead and log off and get 45 minutes of your night back. If you completely understand how options work already, then this webinar is probably not for you. And if you are not open to additional coaching or training, then this webinar is not for you, because at the end, I'm going to offer you an opportunity to get some additional coaching or training. If that's not something that's for you, this webinar is probably not for you. All right. So let's keep it moving. So let's go back. Why am I sharing this information with you? So if you don't know me already, I'm assuming some of you guys know me, but maybe you found me through YouTube or Facebook. But if you don't know me, I've been trading for over 10 years. I've been trading since 2003. So I've been trading over 10 years. I grew a small account to a six-figure trading account with no formal education. And, since then, I've made a lot of money, lost a lot of money, made it back, lost it. And people would always ask, what am I trading? What am I teaching? And so I started blogging about what I'm trading, and I started a website, and then people started following me on YouTube and started doing tutorials. And then I wrote a couple courses, right? So that's me in a nutshell. But why am I sharing this information? I truly believe with everything in me that if more people knew how money works, if they knew how the stock market worked, we would be in a better place as a society, right? I mean, just think about it. If you had an opportunity to provide for your family, buy a car, move into a better neighborhood, give more at your church, give more to the charities that mean the most to you, then we would probably have less people robbing, stealing, killing, less people having abortions. I know you're like, well, whoa, he's getting deep on this webinar, but that's why I like to share this information, is because I was in the seats that you're in. I wish somebody would share it with me. I was on the outside looking in, wondering how does this whole thing work? How do people make money off the stock market? What are options? I didn't even know there was an option component to the stock market. And so now that I've been blessed with this knowledge, and it's not like it fell out of the sky as a blessing. I mean, I went and learned and studied and followed traders. And so now I'm in a position where I can teach it. And so that's why I'm sharing this information. So please take the next 45 minutes seriously, because I took it seriously preparing this information for you. And someone said that's noble of you to share the information. Hey, somebody's got to do it, or at least we all should be doing it, and we'd be in a better place, right? So let's dive into it. Why do option traders have a unique advantage over stock traders? So I want you guys to type in the chat box. What do you think? Why do you think option traders have a unique advantage over stock traders? So you're going to help me out with this webinar. I'm not just going to be talking at you. I want you to interact with me. So why do you think option traders have an advantage over stock traders? Just type it into the chat box. What do you guys think? And if you don't know, that's okay, but take your best guess, right? Roop says small equity. Dave says buying power with less risk. Actually, you're right on the money. Ethan says you can make money in an up, down, or sideways market. You've probably been following my stuff, but that's right, Ethan. Marcus says more leverage. Jason Shepard says less total risk. Alex says profit 100-fold per contract. Yep. Gabby says make money if the market goes up, down, or sideways. Where in stocks you only make money where the stock goes up. Wow. All right. So you guys are kind of already into my presentation. And this is make money in up, down. Keeps us more control. All right. So perfect. And so you guys, some of you already know, but first let's discuss how do stock traders make money. So if you don't know how stock traders make money, I'm going to break that down for you right now. So stock traders basically buy low and sell high. That's exactly what they do. So you can see here, if you're a stock trader, the only thing you know how to do is hopefully you buy something at $10 and you can sell it for $50 someday down the road, right? But that just means you only know how to make money if the stock market goes up, right? What's the problem with that? Well, most stock traders' mindset is they're going to ride every trade to the moon, right? That's how stock traders look at every trade. They look at it like it's green. They only see green, like this trade's going to the moon. This is the one trade that's going to take care of my family for the rest of my life. This one trade, that's how they think. One trade or every trade is going to the moon. But what is the reality? There's the stock trader's reality, right? They end up holding those stocks, riding them right into the ground, because we all know stocks do not always go up, right? And what goes up at some point usually ends up coming down. And most people just end up riding their stocks all the way down into the ground. So that's the real reality of the stock market if you only know how to buy stocks. Because we all know stocks can move in three ways. Some of you have already alluded to it, right? Stocks can move up. That's no surprise to anybody, right? Stocks can move sideways. Well, what do I mean by a stock can move sideways? If you buy a stock, for example, at $10, it moves all the way up to $100. Then it falls to 50, then it falls to 40, 30, and it falls to $10 5 years later. That stock essentially just moved sideways because you bought it at $10 in 2005, and in 2010 it's back at $10. So you didn't make any money, it just moved sideways. So you basically wasted time. And then we all know that stocks can move down, right? So here's the question I would ask everyone that can hear my voice. If we know that stocks can move sideways and we know that stocks can move down, and we just covered that stock traders only make money pretty much one way, and that's if the stock goes up, wouldn't it make sense to ask yourself, well, wait a minute, if stocks move up, down, and sideways, and I only know how to make money one way, that's a 1 in 3 chance of making money. Let me ask you, are the odds in your favor or are they against you? You don't have to be a rocket scientist to know that if you only know how to make money 1 out of 3 possible ways, the odds are not against you. I mean, the odds are not in your favor. The odds are against you. Now, you might say, I could short some stock, right? And that's this slide right here. Shorting stock has unlimited risk. So if you're not familiar with what shorting stock is you saying, I'm going to sell something to someone that I don't have, and I'm going to hope I can buy it back at a lower price. So if I told you, hey, you can come buy my Apple stock today at 100. I don't own Apple stock, but I tell you, you can buy it from me at 100. Well, we enter that trade and you enter it short. You're short because you don't have the stock. You're hoping Apple falls down to something below 100 so that you can buy it. So if it falls down to 90, then you would actually buy the stock in case I come knocking on your door for it. I already agreed to buy it to you at 100. You bought it at 90. You'd give it to me. Well, what's the reverse can happen? Well, what if Apple never falls from 100? What if Apple comes out with a new phone and it goes to 120, 150? What if the iWatch is a big hit and it goes to 200? You have to still go buy that stock at 200 and give it to me at 100 because you agreed that I could buy it from you at 100, whether you owned it or not. So that's where the unlimited risk comes in with shorting stock. You're selling somebody something you don't own. That's not smart. That's unlimited risk. So again, I'm trying to prove the point that essentially stock traders can only make money one way, and that's if the stock goes up, buying low, selling high. So I asked, why do option traders have a unique advantage over stock traders? The answer is very simple. Option traders have way more tools to build their house with than a stock trader. Stock trader has one tool: buy low, sell high. Option traders, they can make money in a sideways and a down market, right? So what are the two tools, or what are the more tools? The more tools are simply two types of options called calls and puts. There's only two options that make up the options market, a call and a put. But man, when I tell you, when you can mix these things together, you probably can get 20 different combinations. So what do I mean? You could buy a call and buy a put. You can, you can sell a call, you can sell a put, you can buy just a call, buy just a put. You can buy a call and then sell a call on top of it, and buy a put and sell a put on the bottom of it. That's called an iron condor or something. Like, there's so many different combinations that stem from just these two options right here, calls and puts. And I want to kind of give you a little insight into both of those tonight. So if you're taking notes, that's one to jot down, right? I need to understand what are calls, what are puts. So let's talk about what are calls. So calls are used for bullish strategies. So call is something that you can buy and control the stock for a certain amount of time for a certain price. So if you're buying a call, you're assuming the stock is going up. That's a bullish strategy, right? On the other end, there's what's something called a put, which is a bearish strategy. So if you're buying a put, you're basically saying, I believe the stock is going lower. And that's where a put starts to make money. And you'll see how later on in this webinar, puts can be used for a few other cool things that most people don't even know about. But the two types are call and put. Calls is a bearish strategy. Calls is a bullish strategy. Puts are a bearish strategy. Now, once you get even more sophisticated, you can flip both of these around and kind of do some weird stuff with it to change the meaning of the strategies. But on the surface, if you're buying a call option, you're bullish. If you're buying a put option, you're bearish. You believe the stock is going to go down. All right. Now, once you understand these two, you have everything that you need, in my opinion, to build financial freedom for yourself. If you're just buying stocks, you do not have everything you need to build financial freedom, because we just discussed you have a 1 in 3 chance of making money. Well, what about the other 2/3 of the time, right? So, which those 2/3 of the time happen more often than you think. Now, have you heard that options are risky? I see people say it all the time, or I see other traders who don't understand options because they don't understand it and don't know how to teach it. they say stuff like, well, why would you do that? Options are risky. Trade penny stocks, or, trade the Forex, or I don't know, all this stuff, binary, do all these different things. But normally that just means they don't understand how options work, because if they truly understood how options work, and I'm willing to have a debate with any other trader, that buying stock is always the risky position and not buying options, right? So trading stock has more risk than options. And don't take my word for it. I am going to prove it to you on this webinar, because my goal is to educate you. So whether you get continued training after this or not, you will at least be able to have an intelligent conversation with someone about why options are less risky and why stock is actually more risky than options. So let's dive into my first example here. So I'm trying to keep it really simple. So we're going to use just a made up stock. It's called stock XYZ. Later on, we'll bring in some real stock and option examples in this webinar. But let's just say you're looking at stock XYZ and it's trading at $100. You could buy 100 shares of the stock, and that cost to you would be $10,000, right? 100 shares times $100 be $10,000 for you to buy 100 shares of that stock. Now, you don't have to answer this, but how many of you have $10,000 sitting around to get started trading? I'm gonna tell you, I didn't have 10,000 when I first got started. I got started with $500 in the stock market, and that's why 500 has always been my magic number. Now let's look at the other end of this. So you can buy the stock, 100 shares, $100, 10,000, or you can buy one $100 strike price option, right? So you might be thinking, what's a strike price? Don't worry, I'm going to cover some of that, or as much as I can in this webinar. But you can buy one contract, which is a $100 strike price. So what that means is someone has agreed to sell you the stock at $100. So a strike is like that agreed upon price. So you bought $100 strike. That's the agreed upon price, one option. An option controls 100 shares. Okay. And then there's a time frame to the option. So in this example, I'm just using 30 days. And then I made up the price of this option. I just called it $5, right? Because you may be thinking, well, where do you get $5 from? Don't worry. I'm going to show you a real option chain. I'm going to show you some real option prices. Okay. If you bought one option contract, the cost to you would be one contract controls 100 shares. So 1 times 100 times $5. So simple math, simple question. You can type this in the box. Would you rather control XYZ stock for $10,000, or would you rather control 100 shares for $500 for 30 days, assuming you know the stock is going to move within 30 days? You tell me, which one would you pick? Type it in the box. Ethan said, nope. I don't know if that's a nope. You don't want to spend the 10,000. Bob says the 500. Rupert says, I'll go with the option. Anthony, I'll go with the option. Dwayne says options. Alex says option. Sandra, $500, of course. Keisha says the option. Cynthia, 500. C. Right. So everybody's saying the option. Laura, Jason, Wendell, Marvin, Nadine, all said the option. Marion says, or Marlon, I'm sorry, options every day, all day, right? So it just makes sense. But as we walk through the webinar, it's going to make even more sense, right? Because I want to show you the different potential that you have with options that you don't have with the stock. So let's keep going. Now, so earlier I told you, I'm going to share with you why a stock is more risky than an option. So let's say, same example, you bought 100 shares at $100, $10,000. On the right side, you bought one contract times 100 shares, $5, so that's 500. What if XYZ stock tomorrow falls $40 overnight? Well, on the left-hand side, you're going to be down $4,000, right? Because if it fell $40, you got 100 shares. You just lost 40 times 100 shares. That's $4,000. On the right side, if that option expires worthless in 30 days, how much did you lose? You lost $500. Just with this example alone, I will pose this question. Now, which one is more risky? Options or buying stock? Just off the sheer numbers alone. you can see that stock is more risky because you don't have a defined amount. Well, I mean, I guess if it goes to zero, that's your defined amount. But with options, we can never lose more than the amount of money we paid for the option. In this case, we bought an option for 500. That is the absolute maximum that we can lose. I don't know about you, but I feel good going into a trade knowing I've already determined how much I'm willing to lose, which is how much I paid for the option. I already have talked to myself and agreed that 500 is the most that I'm willing to lose. On the left side with the stock, it's unlimited, right? I mean, the stock could go to zero. Have you ever seen a stock go to zero? I can tell you a few. Kmart, Enron, right? Some of these stocks have went to zero. The company went out of business, right? And your shares went to zero. Well, on this side, your option, if it goes to zero, the most you'll lose is 500 in this example. Now, when I ask you, do stocks fall $40 overnight? If you don't believe me, I'll show you some examples. But options can also be used as protection, as income protection, which I'll show you in a second. Because if you're in a trade and you're making money, one of the worst things that you can do, and I see this happen all the time when it comes to earnings season, most people will hold a trade all the way up to earnings, and then the company may come out, announce bad earnings or something like that. And then everything that you've built up over the last 2, 3 months, 6 months, the stock's down $40. We're going to show you how you can protect that income with options. So the way that you can protect it is by using put options. So put options gives you the right to put the stock to someone else at a specific price. It actually allows you to profit from the fall of a stock. Now, you couldn't do that when you were just buying the stock itself. If the stock fell, you just were out of the money that it fell. But with put options, it gives you the right to put it to someone else. So let me give you just a hypothetical example. If stock XYZ we just talked about was trading at 100, if I bought a $90 put, if that stock fell down to $50, because I had a $90 put, I have the right to put that stock to someone else at $90, even though it's trading at $50 now, because I bought a contract that says you agree to allow me to put this stock to you at a certain price for a certain amount of time. So on the flip, it allows you to protect your portfolio as well. So let me give you an example of how this works. So we still got the same XYZ stock trading at $100. You got 100 shares still, but this time the stock falls $40. On the right hand side, you own a $90 strike put contract at $3. So the cost for one contract times 100 shares is times $3 is 300, and we're going to assume that's a 30-day contract, right? On the left hand side, your account, if it falls, your account is down $1,000 here. Let me take a moment, slow down, make sure I'm explaining this right. If you have 100 shares at $100, okay? So you own 100 shares at $100. Once you buy a $90 strike price put, yes, that put costs you $300. If the stock falls $40, you will only lose $1,000 because your put kicks in at the $90 mark. So even though the stock fell $40 from 100 to 60, that put kicked in at 90. So all you really lost was the difference between 100 and 90. So that's $10. And that $10 times 100 shares is why it says your account is only down $1,000. I want to make sure you guys are following me on that. So type in the box. Does that make sense? If not, I'll explain it again. Marcus says it makes sense. Gabby says, yes, it's like insurance. Then it's absolutely like insurance, Gabby, which is what I talk about in my course. Wendell says it makes sense. Alex says it makes sense. Alex says, please explain it again. All right, so let me explain it again. Sheila wants to hear it again. Okay, C says, sorry, it didn't make sense. All right, so for all of you who said you didn't really understand it, I want you to think about it. Think about it like this. You bought the stock at $100 a share. You bought 100 shares at $100, right? If the stock falls $40, so let me let me clear some of this off the screen. Let me just go back a little bit. Think about this. If the stock falls $40, okay, how much is the stock trading for if it falls 40 bucks? It was trading at 100, it falls 40 bucks. So you guys type in the box, how much is it trading for if it falls $40? 60, right? Marcus type 60, Laura type 60, Sheila type 60. All right. So that's simple math. You own it at 100. The stock falls $40. Now it's trading at 60. Okay. So if it's trading at 60 and you paid 100 for it, you lost $40. You own 100 shares, you just lost $4,000. Okay. Now, if you bought the $90 strike price put, what happens is the stock still fell down to $60, but you have the right to go to someone else and make them buy it from you at $90 because you have a $90 put. So if a stock is trading at 60 and you have the right to sell it to them for 90, that's a $30 price difference in there. So the stock fell $40. You can make 30 of it back because you can force somebody to buy it from you at 90, even though it's trading at 60. So you really only lost the $10, right? Because it fell 40, but you can make 30 of it back by forcing someone to buy it from you at 90 because you own that call option. So that's how your account is only down $1,000 because you made 3,000 of it back, which is $30 times 100 shares. So I hope that makes sense. I have to move on, but I hope that makes sense. I got a lot more examples to go through. You'll probably catch it on the next one if you didn't, but let's just pause real quick. Did that make sense? Keisha says, so they have to buy it from you at 90. Yes, because you bought a put option, which means someone sold you the right to put it to them at 90. So when they sold you a put option and you bought it, they entered a contract with you. And that contract says, hey, I have the right for a certain amount of time to put, that's why it's called a put, to put this stock to you at $90. Now, let me spend a couple extra minutes here. You may be thinking, why would someone sell me the right to put the stock to them at 90? Because the stock market has two types of people. One person think the stock is going up. One person think the stock is going down. So the person who thinks it's going up is saying, this stock isn't going to fall. This stock isn't going to fall. It's going to go up. So I'm going to sell them this contract and they're going to keep that $300. See, that costs $300, but who gets that 300? The person who sold it to you. So that person's thinking, I'll make a quick $300 because the stock isn't falling. You might be saying, I'm willing to spend $300 to protect my $10,000 investment. And then we let nature take its course. The next day, the stock fell $40. Somebody else asked, why didn't they just set a stop loss? Well, let me ask you this. How can you set a stop loss if the market is closed and the next day it just opens down $40? How can you set a stop loss if the market opens up the next day down $40? There's nothing you can do about that, right? So let's move on. Some people got it, some people didn't, and that's why it takes way more than a quick webinar to explain options. But I'm giving you a taste of the power of what options can do here. So let me show you an example. So someone said, why didn't they just set a stop? Well, follow me on this. Look at Baidu. Anybody ever heard of this company? A little company called Baidu. You can see on July 27th, Baidu closed at 197.58. Where did Baidu open the next day? Look at the second arrow. Baidu opened at 172 and it went as low as 162 on July 28th, the next day. All right. You can see that alone was over a $35 drop overnight, right? Maybe they had bad earnings. So you woke up the next day, that stock is down $35. There's nothing a stop loss can do to protect you from that because the next day the stock is just down $35. But if you knew earnings was going to be released after the bell, the smart people The smart traders like myself, I never hold stocks over earnings. But if I do, I'm going to buy some protection because you could wake up the next day and the stock is down $35 and there's nothing you can do about it. Let's look at another example. Look at a little company called LinkedIn. Anybody familiar with them? LinkedIn on April 30th, 2015. Look at it. It closed at $252.13. LinkedIn opened the next day, which was the first day of the next month, May 31st. It opened at $206.86 and traded as low as $198.40, right? That's over a 50-point drop overnight. You think some people were sick about it the next day? That's an amateur. Think about if you had $10,000 tied up in LinkedIn and you say, "Oh, I'm just gonna hold it over earnings. I know it's a great company," and then they have poor earnings, and then the next day you wake up it's down $50. That is what the power of a put option can do. It can protect what profits you have. It can protect your portfolio from waking up and foolish things like this happening. And these happen every day. I shouldn't say every day, but it happens when there's a lawsuit. It happens when there's earnings coming out. It happens when a new product is coming out and it's not as big of a hit as they thought. It happens if you wake up and find out the CEO's been stealing from the company and all of a sudden they've been cooking the books. So this stuff really happens. I'm just letting you know how you can protect yourself from it and protect your portfolio, especially around earnings season. But this is the stuff that other professionals don't tell you. This is the stuff that other people don't share with you. So Ethan said, what happens if the stock goes up and you have that put? Well, you paid $300 for that put in that one example. You basically lose your $300. I want you to think of it as insurance, right? So I talk about this in my course, but think about it like this. Think about options as insurance. You pay insurance every single month, but what happens if you don't get in an accident? Do they come give you a refund for your insurance? Absolutely not, right? But you had that protection in case you totaled your car. This is protection in case you total your portfolio. So I want you to think about it like that. All options are contracts that people use every day. They use option contracts in real estate. They use option contracts in insurance. Insurance company doesn't call you up and say, "Hey, I want to enter into an option contract with you." No, they say, "We're willing to take on X amount of risk based on your driving record and based on your age and based on where you live. And for that, we want to be compensated X amount of dollars every month. And if you get in an accident, we will pay you. But based on your driving record, this, that, and the third, we don't think you're going to get in an accident. So we're willing to insure you." Same thing. Based on the stock chart, you should be telling yourself, do I need insurance or not? Do I need some put options? Based on if earnings is coming up around the corner, you should be asking yourself, do I need insurance, right? If I don't get in an accident and LinkedIn goes to the moon, I just spent $300, but I'd rather spend the $300 to protect 10,000. Same thing if you're driving a Cadillac or some nice car. You would rather spend the $175 with your insurance company than to get out here and crash the car tomorrow. And now you got to figure out how you're going to pay for a $40, $50, $60,000 car. So people pay for insurance for their cars, but why aren't you protecting your portfolio? Chances are you probably never knew about this stuff before tonight, right? Let's keep going. So let's talk about some of the secrets to, well, let me take a pause. Is this good stuff? Let me know. Is this helping, guys? Let me know. Type in the box. I want to make sure this is valuable and good information to you. Alex says yes. Gabby says yes. Dave says yes, sir. Jason, good stuff. Sheila says yes. Dwayne, Anthony, Marvin, good. Very valuable. Ethan says. Marcus says develop a new strategy. Oh, yes. Caesar says it's making sense. SE, it says your name is, as someone new to this. Yes, this is helpful. Awesome. Awesome, guys. So that's always my goal, to provide some value and make it make sense. Let's talk about the secrets to growing a small account. All right. So there's two secrets to growing a small stock trading account. Number one, both of the secrets are using options, by the way. But there's two ways to use options. You can buy contracts in volume, meaning a high number of contracts. High for me is 5 to 10. and you're buying 5 to 10 contracts of low price stocks that move at least 50 cents to $1 within a 30-day time period. And I'll show you why that's important. The other way, use options to power up a small account. You can buy smaller contracts of high price stocks that are fast moving. I'm going to show you two examples of each. So hang with me here. So I'm going to walk you through what I mean in both situations. Okay. So here's a chart of a stock called SNV. What I call a low price stock is any stock that's under about $50. Sometimes I try to keep it under 30, but definitely under 50. That's a low price stock to me. Now, I want you to look at this stock chart because if you took my foundations course, this is where the foundation starts to come into play. You have to be able to read a stock chart and determine where the stock is going before you can pick the right option. So I want you to look at this. If you can see this, like this big sell-off happen, and then you can see mid-August, right, which is not too long ago, 2-3 or about a month ago, because we're mid-September at the time of this webinar. So mid-August, you can see here it had a big sell-off, but since from mid-August it went from about $27 up to $30. You can see that on the chart, right? So that's about a $3 move. So I want to talk to you about what a $3 move could mean for you. And if you look back even further than that, you can see the stock's been in the uptrend. So you can see it's been moving at least a good $3, it looks like, every 30 days or so. Now let's look at an option chain and talk about what option you should pick and what that can mean for you. So if you look at an option chain, you have the ability to control, you can see 122 days to expiration. I can buy an option to control this stock for 122 days. Okay. 122 days, that's what, like 4 months or something? 4 months I can control this stock. If you look at the example I pulled up, I'm looking at the $25 call option. So that's what we call an in the money option because the stock is trading at $30.82 right now. But I'm going to go in the money and buy a $25 call option. So for that, you can look over here at the price. Let me ask you guys this. How much do you think you should pay for that option? Because I did this earlier and I bet everyone gets it wrong. How much do you think that option should cost to buy the $25 strike price call option to control the stock for 122 days all the way out to January 2016? How much should that cost? Just take a stab at it. How much would you pay per contract? Alex said 450. Well, per contract, how much would that cost per contract? Rupa says 250. Marcus says 530. Okay. Marcus, you're close. You're close. Sheila says, don't know. Rupa says it's 2,500. Jamil says $5. All right. So let me break down how this works, guys. On the left, you see something called a bid and an ask. So bid means someone's willing to pay $5.30 per contract. On the right, someone's saying, hey, I want $6.40 to sell it to you. So that's what creates a market. Someone says, I'm willing to pay $5.30. Someone says, well, I'm willing to sell it at $6.40. And then at the very far left, you see something called last. That is the last price it sold for, which is $4.50, right? So you got what someone's bidding, what someone's asking, and then what the last person paid for it. But here's what the smart traders do. Smart traders look at the intrinsic value plus the time value. If you actually add those two together, you should actually be able to buy this for $5.85 because it has $5.82 of true value and you're paying 3 cents for time value. Now, that might not make sense to you right now because you're just learning options, but it's made up of two components, the true value and then how much am I paying for time. And so when you put those two components together, you actually should be going in and offering $5.85. But if you don't know that, you'll go into the market and you'll pay $6.40 for it and you'll overpay for this option. And if I'm a market maker, I'll take that trade all day because you just didn't know how to price out an option correctly. So there's a lot of little tricks and different things like that to understand that what's the right price to offer for an option. But again, if nobody shares this with you, you don't know, right? So let's move on with the example. So the stock is trading at $30.82. We just saw that from the chart. Let's just say you bought 97 shares. And the reason I picked 97, I'm going to assume you got $3,000 to work with here. So let's say you bought 97 shares. Cost of 97 shares at $30.82 is $2,989.54. Okay. Now, on the right side, the call option. So let's say you bought 5 January 2016, $25 strike price. That's the price we were looking at. Option contracts for $585. So I just showed you how I came up with that $585 number. The cost of that would be 5 contracts times 100 shares, because a contract controls 100 shares, times $5.85. It's going to cost you $2,790. So they're kind of close, right? You're spending a little under $3,000 for both of these trades. But let me show you where it makes a difference being an option trader. So this is all assuming you only have $3,000 to invest. For some of you, that's your tax return, right? You can get $3,000 from your tax return, which is coming up in 4 or 5 months here. So assuming you got $3,000 to invest. Now let's look at what happens if the stock moves up. So if the stock moves up $3, on the left-hand side, your profit would be $3 times 97 shares, because that's how many shares you own. So you would make $291. Woohoo! Congratulations, right? But look at the right side. If the stock moves up $3, because we bought a deep in the money option, that option is going to gain in value dollar for dollar as the stock would. So if the stock moved up $3, we have 5 contracts. So $3 times 5 contracts times 100 shares, because a contract controls 100 shares, we make $1,500 on the option side. And how long do we have for it to move $3? We got 4 months. Because remember, let me back up. Let me back this up a little bit. Remember, we're looking at the 122-day expiration options, okay? If you're wondering where I'm looking, there's this look up the yellows, yellow, yellow, yellow. Look to the top where it turns gray. It says to the left where it starts to turn gray. 122 days to expiration. Okay, so I have 4 months for it to move $3 for me to make $1,500. Okay, let me go back to the example. All right, so let me ask you this: would you rather spend $3,000 and try to make $291, or would you rather put $3,000 at risk to make almost a 50% return? On the left side, we're talking about a 10% return, 291. On the right side, we're talking about a 50% return. Which one would you rather have? Type it in the box. You tell me. If anyone says I'd rather have the left side, log off now. No, I'm joking. I'm joking. But the point is, I don't know why would you not want the right side of the equation? Let me see. I got a couple questions coming. Dwight says, can you sell the option before 120 days? Yes, you can. You do not have to wait for 122 days. You just have control for 122 days. So you needed to do something within 122 days. But if it doesn't in 30 days, you can sell the option and get out in 30 days. So absolutely, you can exit that trade. Rupa Patel says, wow. Yeah, exactly. Blew my mind too when someone really showed me how this thing works. Sheila says the right side. Dave says, do you normally buy that much in the money? Good question, Dave. I do talk about this in the course, but I do go deep in the money on stocks under $50 because they don't move that much. So when it does move, I want to catch the bulk of that move in my option. So if the stock is a $30 stock like this, it may take a month to move $1. It may take 2 months to move $3. When it moves $3, I need to make sure my option is going to move $3, $4. So yes, I would go deep in the money. Now, if I'm talking about a Netflix or something like that, I might go out of the money because that stock can move $30, $40 in a month, and it'll kind of like swallow up my option being out of the money, and it'll put it in the money. But that's a whole nother topic. But hopefully that answered your question. Dwayne said, Dwayne, I would take the right side any day. Absolutely. C said that makes sense now. Good, good. 1500. Good to know you don't have to wait 3 months. Options every day, all day. Dave says makes sense. Rupert says do options on commodity or currencies or indexes. You can do options on almost anything. I just trade options on stocks. That I don't really get into commodities and forex. Somebody else may, but that's just not my thing. But if it has if it has options, go for it. Cool. Windows says makes sense. All right, so let's keep it moving. I hope you guys are getting a lot of value out of this, right? So let me walk you through one more stock chart, one of Tesla, right? So we did a low price stock. Let me do a little bit of a higher price stock like Tesla. Okay. So Tesla makes the electric cars. So these guys are trading at $253 here and 57 cents. You can see based on the chart. But if you look at where Tesla had its big fall in August, Tesla fell down to $200, and then in a month, okay, mid-August to mid-September, it's ran up $50. $50. So I'm going to show you how this would work on a more expensive stock like Tesla. So let's look at the option chain for Tesla. I would still look at a potential in the money option, the $235 option, but notice on Tesla, I can only control this one for 31 days. So stocks that move big and quickly, they get more expensive if you try to control this for 6 months or 122 days. This would get really expensive. So because these move faster, you only need to control them for a shorter period of time, or else these get really expensive. So in this example, you can see the bid was $23.80 and the ask was $24.55. And the last price sold was $24.05. You can see how I got it broken down by how much you're paying for time value and how much you're paying for true value. That's important for you to know and be able to read that. Now, let's do the Tesla example, very similar to the last example we just did. All right, so you buy 100 shares of Tesla stock. First of all, 100 shares of this stock, now that it's a big boy, is $253 times 57 cents. That's going to cost you $25,000 just to mess with a stock like Tesla. This is what keeps most people from playing with the big boy stocks and the stocks that really could change your life. Most people don't even trade them because it's out of their reach. That's because they don't understand options. Now, let's look at the October 2015 strike, which is the chain we were just looking at, the option chain. That contract is going for $24.55. Okay. So the cost of one contract to control 100 shares is now $2,455. That's a big difference, isn't it? Big difference. Do you have 25,000 to trade Tesla? No, but I bet most of you do have $2,455. Now let me walk you through the example. That's a $22,902 difference versus the person who only knows how to buy stock compared to the person who knows how to trade options. Okay. Remember the chart of Tesla. It went from $200 to $250. That's a $50 move within 30 days. Okay. Now let's walk through it. The stock rose $50. Over on the left hand side, you got 100 shares. It rose $50. You'd make $500. Where in the world would you put $25,000 at risk just to make $500? That is not a smart trade. On the right hand side, you own one contract at $2,455. And if the stock rose $50, you would make anywhere between $4,000 and $5,000. The reason there's a price range is because the stock isn't as deep in the money, so it may not move dollar for dollar with the stock price. The option is not deep in the money, so it may not move dollar for dollar with the stock price. So let me kind of clarify that. If the stock moves $1, the option might move 75 cents. Okay, so it's not moving dollar for dollar because it's not that deep in the money, but you could go deeper in the money, but it gets more expensive on bigger stocks. So that's why it says ideally you'll make anywhere between 4,000 and 5,000. Now there is something that you can calculate out that'll give you exactly what the option will move if the stock moves a certain amount, right? So I talk to you and show you how to calculate all that. But the point is here's the point. Do you want to put $25,000 at risk to make 500? Or do you want to put $2,455 at risk to potentially make $4,000 to $5,000? It's a simple no brainer. I know which one you would pick, and so that is that's the webinar, ladies and gentlemen. I do have an opportunity that I want to show you one of my new courses that's coming out. But before I get into that, let me just open it up for questions real quick, and then I'm going to talk to you about a course that I have that really teaches you how this all works. And whether you get the course or not, I'm hoping you got immense value out of this tonight. But in a minute, I'm going to open up the course and kind of show you what's in there and how I break all this down. But first, let me open it up and ask, what questions do you have? Sheila said, is it a good idea to buy options on stocks under, I don't see the rest of your message, under $10? It just depends, Sheila. If a stock's under $10, it's probably only going to move somewhere between 30 to 50 cents. So now it's about volume. How many shares can you buy to make that 30 to 50 cent worth your time? Because a stock under $10 moves 10 cents a day, 5 cents a day. So it just really depends on your strategy and how many contracts you can buy to make that 50 cent worth your while. If you're buying 100 contracts and it moves 50 cents, well, that's going to be worth your while. If you're buying one contract and it moves 50 cents, I think that's like $50. Not worth your while. You're going to pay commission getting in and out of the trade. Not worth it. Howard said, what's the difference between in the money and out of the money? Howard, the in the money option is an option that has real value. So if a stock is trading at $100 and you go buy an $80 option, it has $20 in the money. Like, why would I sell it to you? Why would I enter an agreement to sell it to you at 80 when it's trading at 100? So that's an in the money option. If the stock is trading at 100 and you go buy a $120 option, that means you agree to you have the right to buy it from someone at 120. Well, it's only trading at $100, so that's out of the money. It's $20 out of the money. So that's the difference between in the money, out of the money. Is there a limit on how many option contracts you can buy? However many you can afford. Can you quickly explain what you mean when you talked about deep in the money? Can you show the 2 secrets to growing small accounts again? All right, so I'll tell you what, some of these questions, Bob says, my biggest concern is with options is when I hear that most options expire worthless. Can you elaborate or explain? I mean, they expire worthless if you don't know how to read a stock chart and buy the right stock or buy the right option, right? So if someone is buying an out of the money option because it's cheap, that's not the right reason to buy that option. You need to have a foundation of looking at a stock chart and saying, where do I think this stock can go based on the chart, based on the momentum, based on where we're at in the overall market, and how long do I think it's going to take to get there, right? So I don't just pick random dates. There's a reason I picked 30 days, 122 days, because I have to look at a stock chart and say, what do I think this stock can do, and in what time frame? Does that make sense? I hope that makes sense. All right, so gosh, you guys have a lot of good questions. So I tell you what, let me switch screens and I'm going to show you guys what we have inside the Options Explained course, because basically everything you're asking, there's no way we'd be able to cover everything on this webinar. But let me just show you what's inside the course, and then I'm going to switch my screen here. So bear with me while I switch my screen. Now, someone asked, can I show the this trade secrets to growing a small account? So let me just flip back to that really quick and show you that. So there it is. If you want to take a picture, or I don't know, but there it is. So hopefully you can see it on my screen there. And I'm going to leave that up there for a minute, and then I'm actually logging into the course right now. And then I'm going to share my screen with you, and I want to show you guys what's back there, because there's a lot of the questions that you're asking inside the course. So let me switch screens here. So for all of you that are asking a lot of good questions, right? This webinar, there's no way that I could teach you everything on a 1 hour webinar, right? So this is the back end of the course. So option module one, we break down what options are in the different industry that use options. Module two, in this option, we break down the foundational components that make up the building blocks of an option. So we talk about the time component, the intrinsic, extrinsic value, all that stuff. Module three, we break down what are in the money call options. So somebody was asking, well, what's an in the money call option? We break that down and how to interpret an option chain. In module four, we learn about in the money put options and how to interpret put option chains. Module five, we break down how to use in the money call option as a buying strategy. And then in six, we break down how to profit from the downturn of a stocks by buying in the money puts. And then under each module, so for example, under module one, you'll see there's like 6 mini modules underneath it that really breaks down the whole process. If I go to module two and break down the option components, you can see here that I'm going to break down all the components of the option. So you're going to understand everything from A to Z by the time we're done here. If we go to module three, you can see we break down call options, and it's called options explained. So you'll know how to use at the money, in the money, at the money, and out the money options to profit from it. I can't even talk, right? Module four, put options. We're going to break down in, at, out of the money put options. And then there's module five. We got call option strategies. There's a ton of strategies here. There's well, actually more than that, right? There's 8 modules on strategies, how to use it for income protection, how to use it for bullish markets, bearish markets, protecting my portfolio, protecting my stock. There's just a ton of buying strategies in there. And then in module six, we break down all the put option strategies here. There's only 4 put option strategies, and we break down why. You can see there's real examples of where to look for, how to come up with, everything. There's bonus modules in here galore. There's a bonus module. I'll show you how to buy stocks at a discount. There's PDFs that you can download. You get my option cheat sheet worksheet. You get the option strategy and profit grid. You get the option formula worksheet, the option buying and selling rules, the option Greek quick reference. There's also a course in here on Greeks. So there's, everything you need on options, I broke down in this course, and it would be way too much to break down on this webinar. So someone asked, how much is the Options Explained course? Let me ask you this. Before I share with you the price, let me ask you this. What would it be worth for all the information I just showed you that's in the course, not to mention knowing how to trade the market the way I just showed you, knowing how to put smart money at risk, knowing how to increase your gains, 50% fold versus 10%, putting less at risk? What would that be worth to you? I'm just curious. I'm going to tell you the price. The price is what it is. Some of my other students are already taking the course who got early access to it. But I'm just curious. What would that be worth to you? For those of you who can still hear my voice, just type it in the box. What would that be worth? Don't worry, I'm not going to jack the price up if you say a price that's more than what it is. Interesting. Sheila said 250. Ethan said 500 to 1,000. Marlon said 1,000. Caesar said a gazillion. Marcus says the course is well worth it. Took it 3 times. You must be in our foundations course because we pre-released it early to the foundations members. Alex says 500. Bob says 750. Dave, you said $49.95. To be honest, I would tell you to kick rocks for $49.90. Maybe you meant $495 because I would say kick rocks for $49.95 if I could show you how to take $3,000 and possibly make $1,500. That was a recent transaction. All right, so let me just give it to you guys straight. I'm going to show you on my screen. If you're, and this is no sales pitch, this is more up to you. If you want to learn how to trade options, I put this course together and I made it very affordable. I'm going to scroll down and I'm going to show you the super low price, but I could have charged $1,000 for this. I could charge $1,200 for this. Other people do, but for me, it's important that everyday average people can afford this, because when I bought my first course, I paid $4,000 for it, and I had to put it on a credit card. I had to apply for financing to do that. And I thought, how many people will never be able to take a course like this because A, they don't have $4,000 to just put on credit. B, they're scared to even take that risk, even find out they don't like it. So my course is $197. And because I'm confident in my teaching and my material, I also offer a 30-day money back guarantee, because if you don't want to be in the course, I don't want you in the course, right? I don't fight with people and argue. Please keep it. I don't have time, right? I'm trying to make this stuff reasonable and affordable for the everyday person to learn the tricks, tips, and the trades that the average, not the average, that the professionals won't share with the average person. So there it is. Course is $197, and it comes with a 30-day money back guarantee. So we're going to be, Dave said, the knowledge is invaluable. Wendell says, I love it. Michael says, great. David says, well worth it. Yeah, I think, David, you took the course. But, you can go to powerstockoptions.com and check out the course. That's where it's at and where you can buy it. We're going to be holding a private coaching session for those. I believe we're hosting that the first week in October, but we're going to be doing a private group coaching for those who have the course to kind of answer some questions, make sure they fully understand options, and make sure that they're getting the most out of the course. So we're at the top of the hour. I'm going to take a few questions, but again, you can head over to powerstockoptions.com and pick up the course. And I'm going to hang out and take some questions from those who have questions. Rupa says, do you take weekly webinars? I'm not sure I understand that question. Do I take weekly webinars? I'm not sure I understand that. Dwayne says, I'm definitely going to purchase options. Hey, pick it up and go ahead and get inside of our private coaching that we're going to do, for those who pick up the course. Sheila says, please email the link to the course. All right, I will email it to you, Sheila. Keith says, Jason, excellent presentation and offer. Hey, I appreciate it. Someone says it's 2 a.m. in London, but oh, nice. Well, thanks for joining us from London at 2 a.m. I appreciate it. It's only like 9:13 Eastern Standard Time here in Detroit. Michael says, Jason, how do you take profit from options? Basically, the same way you bought an option, you basically sell the option back to the market. So, when I showed you an example of where you can pay $3 for an option, well, if the option rises in price, you can sell it back for like $6, or I'm just using as an example. So you basically do the opposite of what you did to get into the trade, which we talk about in the course, how to unwind. Rupert says, if I register for the course. Oh, if you register for the course, we're going to do like a one-time group training, but I do have a private coaching group that if you filled out, let me go to my website and show. If you're looking for to be part of our group coaching session, if you go here and just click work with Coach Brown, you click that, there's a coaching application for you to fill out. And once we reopen it, which will be sometime in October, we're going to reopen it back up. We do weekly webinars where we jump on line live for an hour on Mondays and we go through stocks and charts and stuff like that. Dave says, thanks for the webinar. Appreciate it. No problem. Bob says, I will purchase options. Hey, I appreciate it. But more importantly, you'll be a better and a more confident trader. Again, that's powerstockoptions.com. Or if you're on my website, you can go to Stock Market Courses and you can go right there as well and just click Options Explained. It's going to be right there. Rupert says, me too, but I would like to attend the live class, as you mentioned, the first week of October. It will be only available for those who purchase the course, because we're going to be talking about stuff that you need to have an understanding of before you get in that live class. Gabby says, you mentioned you like to go deep in the money for stocks under 50. Is there a certain amount of prices in that you go? Yeah, Gabby, I talk about that in the course, but I usually like to go about 2 to 3, usually 2 strike prices in the money. And there's a certain reason why. Sometimes when you start to go 3, it gets too expensive, but there are some things that you need to look at that'll tell you how much the option will move if the stock will move, because that's really what we're looking for. How much will this option move? per $1 movement in the stock. So that's really how you determine what option you're going to get. Sheila says, do I get to keep all the courses? Yeah, they're all online. So once you pay for it, you can watch it as many times as you want. And trust me, you're going to probably need to watch the options course once or twice. You may not get everything the first time. You may not fully understand. Marcus says, do I have an opening for coaching? Not yet. I'm going to send an email out when we open that back up, but I wanted to launch the Options Explained course because you'll get more out of the coaching if you understand, if you took foundations and you understand how to read stock charts. And then when I start saying buy the $10 call or look at this, you won't be like, what's a call option? I won't have time to stop in a live webinar now and do a training on what's a call option. So that's why there's a sequence to taking these courses and then getting into the private training, because it's not fair to the people who understand what it is and they're paying for expert coaching for me to come in and start saying, well, here's what a call option is and here's what, all right. So hopefully that makes sense. Cynthia says, I will purchase as well. It is on the bottom of the foundations module. Yes, I think if you're in the back end of foundations, you can purchase it as well to use it. Gabby says, or certain ratio of strike price to option price that you look for. No, it's not a ratio. It's more about, Gabby, about how the option is going to move in relation to the stock. That's really what I'm looking for. Bob says, can I trade options in my IRA? You can. You normally have to get approved to trade options in an IRA. So you have to check with Fidelity or whoever you have. But normally you can, yes. Chase says, is there a minimum amount of money you have to fund an options account? I believe with Options Express, you need, don't quote me, I want to say it's $2,000, but that's only if you're going to use margin. If you're not going to use, well, you can't use margin with options anyway. If you're not using margin, there is no minimum with Options Express, which is normally the broker that I recommend. Dwight says, how much is coaching? Oh no, I'm not going to go down that rabbit hole right now. It'll be a reasonable price once we reopen it back up, but any price is too expensive if I don't build value for what you're going to get. So, but trust me, I mean, you can see from if you took a previous course of mine or this course, you can see I'm not out here trying to price gouge. It's just, I have to pay for an internet connection, a microphone. I have to pay for internet storage. I have to pay for web software to allow you to log in and this stuff. So that stuff's not free. That's what you're really paying for, because the information is priceless. But I always try to make it a reasonable price, right? But GoToWebinar charges me to pay to have these webinars. So that's why we have to charge for the stuff, to be honest, and obviously my time, or else I could be asleep right now, right? Just like you. Gabby says, also already took your options course and love it. Going to refresh and take it again. Awesome, Gabby. Cool. I'm glad yes, I saw your name come through when you purchased it. Marcus says, you just answered my question. Keep up the good work, sir. I've learned a lot from you over the past few months. Hey, awesome, man. I appreciate it. I'm out here trying to share the stuff that the big boys aren't willing to share with the little guys, right? Because if a bunch of us little guys get this knowledge, what happens if all of us collectively have $100,000 to put into a stock trading account, right? What happens if all of us take the money we make from the stock market and go buy real estate somewhere, right? It's bigger than just the stock market. Once you start making this money, what's to stop a group of us from going to buy a couple of franchise restaurants, cash money, right? So, you just don't understand where my thinking is at with this, right? The more people we can help, you just don't know how far that money can go and what we can do collectively as a group, as a team. But that's how I'm going off on a tangent, but that's how I think every day. So that's why I love sharing this information, right? It would mean so much for me for a year from now for you to jump on a webinar and say, hey, because of something you taught me a year ago, Mr. Brown, I put my kids through college cash money. None of them have college debt. That's what this stuff is about, being a smarter trader so you can use stocks and options as a bridge to get where you want to get in life, right? I'm going to try to run through these questions. I see a couple more questions. Michael says, great job. I'll contact you, and I hope you present me with the link of your offer through email. Yeah, if for some reason you need to email me, just email info@thebrownreport.com. Sandra says, I have been reviewing Bollinger Bands, candlestick charts, and recently learned about oscillator. Aaron, is there any single technical fundamental you use, or do you use several? I mean, I use Bollinger Bands, I use MACD, I use stochastics, but that's for a whole nother webinar. But I use a lot of different things. Do you post your webinars on YouTube? Not all of them, but I may post this as a replay. Marvin says, thanks. Thank you, Marvin, for joining. Liddell says, do you day trade or teach on day trade? I got a free course on day trading. If you want to take that, look at the screen right now. It says the good, the bad, the ugly of day trading. I mean, it just kind of teaches you what it's all about. I used to day trade, but to be honest, I don't day trade anymore because when I looked at my life, I got into this so that I didn't have to sit in front of a computer for a boss or sit at a desk every day. When you start day trading, you kind of start sitting at a desk every day watching the stock market from sun up to 4 o'clock when it closed. That's not a lifestyle to me. You just bought another job. So I personally don't day trade anymore, but I used to, and I was successful at it. I just don't. You're basically trading time for dollars when you're day trading because you're in front of a computer all day long. At least that's how it was for me, and I'm just not interested in anymore. I'm more about 30-day trades, 60-day trades, making 5,000, 10,000, and I don't have to look at it every day. I just need to look at it once a week. Rupa says, we have access for how long to the web course after registration? Once you pay for it, you have access to it. I mean, forever, for life. So it's on the web. As long as I'm paying for my web hosting every month, which I do, it's just there for you to take the course. All right. Rupa says, till what time period? I'm not sure I understand that. It's just on the web until you take it. Have I ever heard of fixed index annuities? Yes. Mateen said, is it basic or intermediate to advanced level? The options course is really intermediate. Advanced level would be talking about spreads, iron condors, some of that stuff. I don't really get into that in the course because you have to have a foundation and an understanding of how options work. If I start talking to you about buying one call, selling another one on top of it, and then buying a put, selling one on top of it, and that's an iron condor, you'd be like, what? Where's my profit? What's the stock? You'd be confused. So I do teach some intermediate strategies, but there's another level to this of sophisticated strategy, and that'll be a whole nother course if and when you're ready for that. Is Options Express available for Canadians? Last time I checked, I'm not sure. But if they're not, check with Fidelity. I think Fidelity works with Canadians. Wendell says, thanks for the webinar, and I bought both courses, and they are great. I got to keep studying more and more the Options Express platform. Awesome, man. And if you're a part of our private Facebook group, post questions in there. Dwight says, took foundations course. Great. Plan on taking the options course. Great work. Thank you, Dwight. Matthew, the online broker is higher in options. The online broker is higher in option than stock. I'm not sure I understand your question, Matthew. Sorry. Jason Shepard says, thanks. He enjoyed the webinar. Thank you, Jason. Roop says, cool. Marcus says, yeah, I need the advanced stuff. Looking forward to October. Hey, I'll be there if you need the advanced stuff. All right, guys. So I tell you what, if you got any other questions for me, don't hesitate to reach out on Facebook. If you need to email me, reach out at info@thebrownreport.com. I hope I answered all your questions. I appreciate you guys spending some time with me. And whether you take the course or not, I sincerely hope you got a lot out of this. My goal is always for my free content to be more valuable than other people's paid content. So I hope you got a lot out of this. So have a great night.